Hey everyone, and welcome back to the channel. In today's video, we are going to be covering a very well overdue topic, which is terminal value. Terminal value is a key component in the intrinsic value section of our analysis, which is where we are coming up with an estimate of future cash flows that the business can produce and therefore figuring out what price to pay. So I've had a lot of questions about the different types of terminal value that you can use and what are the formulas relating to that and which are the terminal values that I personally use. So I'm going to be covering all of that in today's video. I'm going to start by giving you a brief explanation of what terminal value is and when we are using it and what is the purpose of it. I'm then going to talk about the three most common types of terminal value that make the most sense when we're talking about stock market investments. And then towards the end, I'm going to show you how you can use my free spreadsheet resource in order to do intrinsic value calculations with a terminal value. And I will show you a full example of calculating the buy price of a stock using my spreadsheet with a terminal value. So without further ado, let's get straight into the video. So first, let me talk about what is terminal value. And terminal value, when we're talking about stock market investing, is an important part of calculating the intrinsic value or the buy price of a business. So when we are assessing the price that we're paying for a business. And if we take Warren Buffett's definition of intrinsic value, what we are looking for when we're calculating intrinsic value is the sum of all future cash flows that a business can produce, discounted at an appropriate rate. So under Warren Buffett's definition, when we're calculating intrinsic value, we need to estimate the future cash flows of a business and discount that back at an appropriate rate. And basically, when we're trying to figure out what price to pay, that appropriate rate that we are discounting back at will be our personal required rate of return. But basically, we need to figure out what those future cash flows are. And we do this with a discounted cash flow, and we do this in really two steps. We have a growth period and then a terminal value. And in the growth period, we are basically coming up with an estimated growth rate that those cash flows can grow at over the next, say, 5 or 10 years. So for my example, in my spreadsheet, I use a 10-year growth period. I'm figuring out what the cash flow for owners figure is, how much cash the business is producing for owners in the previous year, and then I'm growing that at a certain rate over the next 10 years. But as I just mentioned, the intrinsic value is not just how much cash a business will produce over the next 10 years, it's how much will it produce over its remaining life. So beyond that 10-year period, we need to come up with an estimate of what the cash flows will be after that growth period. And we use a terminal value in order to make that estimation. And there are a number of different ways that you can calculate a terminal value depending on what type of investment you're looking at, whether it's a stock market investment or some kind of other investment such as a property investment or an internal investment. And even within stock market investing, there are a number of different ways that you could go about estimating the cash flows that occur beyond that 10th year. So the first and most common way that you will see people apply a terminal value when analyzing businesses is what's called an exit multiple terminal value. So this basically means that you estimate future growth for 10 years or 5 years, for example, and then you add a multiple to the cash flow figure or the earnings figure in the 10th year. So for example, previously in my spreadsheets, I have used a 10 times multiple, which means that basically I'm assuming that the business grows their cash flows for 10 years, and then at the 11th year or at the end of the 10th year, I'm able to sell that business for at least 10 times its cash flow that it's producing in that 10th year. It's a lump sum that I'm receiving at the end of a 10-year period. Now, as I mentioned, prior to doing some deep analysis into the types of terminal values that we can use, I was using a 10 times multiple exit terminal value in the spreadsheet and in my valuations. But this method has really two major substantial flaws that I think make it why you probably shouldn't use this method, and why one of the methods I'm going to explain later in this video makes a lot more sense. And the first reason is that when you are adding a multiple to cash flows at the end of a period, you are no longer really doing analysis of the future cash flows that a business can produce. What you're really doing at that point is relative analysis. So you're comparing businesses in an industry and thinking about what price people are willing to pay as a multiple on that earnings. So for example, in high growth tech companies such as Facebook and Google and Amazon, you will see that they have price to earnings ratios. The multiple on their earnings is sometimes 30 or 40 times earnings, whereas there are other companies where the multiple is much lower. And if you're thinking about applying an exit multiple, you are now doing relative analysis rather than thinking about the cash that that specific business can produce. And the other flaw that I have had from using a 10 times multiple and applying that to all businesses in my valuation is that it's an arbitrary figure. 10 doesn't mean anything specifically, and therefore it doesn't make sense to be applying a multiple, say, of 10 or 8 or 15 to every business that I'm analyzing. Some businesses after 10 years will continue to grow and have a very good chance of continuing to grow at maybe 5, 6, 7%, maybe 3 or 4% into infinity, or theoretically for the next 10, 20 or 30 years. And other businesses will not be growing after the 10-year period. So to apply a standard 10 times multiple to every business, assuming that you can sell any business for 10 times their cash flows in the 10th year after 10 years, is pretty arbitrary and doesn't really make any sense. And just briefly to show you how I'm calculating this terminal value for a multiple, very simply, we're taking the 10th year cash flow generated by the discounted cash flow and we're multiplying it by 10. And that gives us the future value of that cash flow. And then of course, like all of the other cash flows in a discounted cash flow, it needs to be discounted back to present value, which means that if it's coming in the 11th year, then we are discounting it back at our appropriate rate, which if we're looking for the buy price, that would be for me 22%. And I'll get into that a little bit later in the video. But we would be discounting back at 22%, which means we're taking that terminal value and dividing it by 1.22 to the power of 11. And that will allow us to discount it back. It's kind of like reverse compounding. Discount it back to the present day. And then we take the present value of all of those future cash flows, and that would give us our either buy price if we're using our personal required rate of return as the discount rate, or intrinsic value if we are using the risk-free alternative. The second method, which is the method that I am now implementing into the spreadsheet because I think this method makes the most sense mathematically, is using some kind of perpetuity terminal value. So a perpetuity with no growth, we'll talk about growth in just a second, but a perpetuity with no growth basically assumes that the business no longer grows after 10 years, but they continue to produce cash flow into infinity. And there is a way of mathematically calculating all of the cash flows a business will produce if they continue to not grow, but they continue to produce cash flow forever, basically. And the formula looks like this. I'll put it on the screen. And it's very, very simple. We are just taking the 10th year cash flow generated by the business and dividing it by our discount rate. What are we discounting by? And remember, again, if we're looking for intrinsic value, then typically you're discounting by the risk-free alternative. And if we are looking for our buy price, then we would be discounting by our required rate of return, which for me is usually somewhere between a 15 or a 22% return. And once we do that calculation, again, that will give us the future value of that terminal value. So it will put it at year 11. And then again, we need to discount that back to the present day, meaning we need to again divide it by 1.22 to the power of 11 if we're using a 22% discount rate. And that way we can get the present value of that terminal value. And I think that using a perpetuity with no growth makes the most sense as a conservative value investor, because we need to recognize that the business is going to continue, or is very likely going to continue to produce cash flow after the 10th year. They're not just going to stop existing, particularly if they have some of the characteristics that we're looking for, such as distinct competitive advantages and a great management team. But it's also good to lean on the conservative side and assume that they don't continue to grow at a rate of 3 or 4 or 5%. If we just assume that they stop growing after 10 years, maybe they grow at 8% per year for 10 years, and then they just stop growing, but they continue to produce cash for shareholders, we are just leaning on the side of conservatism, which is what you want to do in order to protect your downside. And then the final method for calculating the terminal value of a stock is using a perpetuity growth formula. So This is very similar to the perpetuity we looked at before, but instead of assuming that the company no longer grows their cash flows anymore, we are assuming that they continue to grow at a particular rate into perpetuity, forever. And as you can see from the formula on screen, it is very, very similar to the perpetuity formula. There's just a couple of changes. The major change is that we now have another variable, which is the growth rate, the terminal growth rate, the growth rate that the company can grow at forever at a stable growth rate forever. And that is the formula on screen. And again, that will create a terminal value in at the end of year 10, which we then need to discount that back to the present day by whichever discount rate we're using. If it's intrinsic value, we're going to be discounting by the risk-free alternative in most circumstances. But if we're looking for the buy price, then we are going to be discounting at our personal target return. Also, when you are using a perpetuity growth formula, the growth rate that you are projecting into infinity forever needs to be smaller than your discount rate. Okay, so if you're using a discount rate for intrinsic value of 1%, because the current risk-free rate is about 1%, then you cannot use a growth rate that is above that. You would get a negative terminal value and it wouldn't make any sense. And whenever people are using a perpetuity growth formula, typically they are using a growth rate that is somewhere around either inflation, long-term inflation, or long-term GDP growth. So somewhere around 1 to 3% is what you might want to put into this formula. Anything beyond that, you're going to be blowing out your valuations. So you don't want to project that a company can grow at 8% per year into infinity, because once you do a fair bit of compounding, that number gets quite large. So if you are going to be using a growth rate, then you want to keep it pretty small. Keep it around 1 to 3%. And as I mentioned, to be conservative as a value investor, most of the time I will be using a 0% growth rate in that formula. Now, I know that this is probably so confusing for people who have never looked into discounted cash flows or never done corporate finance or anything like that. And what I've sort of been alluding to throughout this video is something called the time value of money. So I'm talking about discounting back to the present day. And that is an entire sort of topic to explain in of itself. So if you don't understand what I'm talking about when I'm saying discounting back to the present value or anything, or the present day value or anything like that, then I'll link a video down in the description below by the finance storyteller who does a good job at explaining the time value of money. Why $1 today is worth more than $1 in the future, and therefore any money that we receive in the future needs to be discounted back to the present day. So go check out that video if you haven't learned about the time value of money yet. But other than that, I wanted to go through quickly before we jump into the spreadsheet and show you how you can easily do it without sort of having to deal with the mathematics. I wanted to sort of cover a couple of questions that I know people are going to ask me in the comment section. And these are questions that I've had in my emails and in the comments of my YouTube videos for quite some time. So I wanted to sort of answer some questions that people had. The first question was, why do you not project cash flows beyond 10 years? So why do I look at a 10-year period for growth and then add a terminal value at the end of that? And there's really a couple of things to say here. The first is that once you get beyond 10 years, it gets very, very hard to accurately predict what a business's cash flows could be. So I kind of have the opinion that anywhere in the first 1 to 3, even the first 1 to 5 years out, it's very difficult to predict what will happen, because during any of those short-term periods over 1 to 3 years, there could be an event like we're seeing now, which could dramatically impact cash flows. So I think the very short term is hard to predict. And then I think anything beyond 10 years is also very impossible to predict. So when you're looking at beyond 10 years, like I said throughout this video, I'm assuming that they continue to produce cash. I'm just not assuming that they continue to grow. And the other thing to mention is that from a discounting perspective, the cash flows that you receive after 10 years are worth so little to you today. Okay. And if you don't understand the time value of money stuff, that's going to make very little sense. But for example, if you are receiving $100 in 30 years time, for example, if a company is producing $100 in 30 years time, if you're discounting that back at 22% per year, which is what I do when I'm trying to figure out what price to pay for a business, then that $100 is only worth to me today 25 cents, okay? Because of the amount of compounding that 25 cents could go through in order to reach $100 in 30 years time. So that basically means that beyond 10 years, beyond 20 years, especially beyond 30 years, the cash flows that the business produces isn't really adding anything significant to the buy price that we're looking for a business. So the most important period for estimation is the next 10 years, the next 10 years out, from today until 2030 or whatever year you're looking out to. That is going to be the biggest impactor of what price you're willing to pay for a business and what you get out of that business as a return. The next question is probably one that is the most common I've ever had on terminal value, and it's why don't you use a WACC when you're calculating the discount rate? Why don't you use a weighted average cost of capital as your discount rate? And this is what they will teach you in traditional finance. I learned this at university, and if you look up how to do a discounted cash flow on YouTube, most videos will tell you to discount using a weighted average cost of capital. But there's a very distinct reason why I don't like using weighted average cost of capital. And it's because it relies on an asset pricing model called the CAPM, the Capital Asset Pricing Model. And this model has baked into it a number of assumptions that I think are verifiably false. So a couple of these assumptions that are required to calculate the WACC are that all investors act rationally, and that all investors act rationally on the latest available public data. And I think both of those things are just obviously not true. There are so many people who invest in businesses without doing any research, without looking at the most up-to-date data, and who are making emotional decisions based on the movements of stock prices. So to have an asset pricing model that is baked into this weighted average cost of capital that relies on the fact that investors always act rationally is pretty insane to me. And as a result, I don't use a WACC when I'm discounting. What I use instead is my personal target return. What return do I want to make on the cash flows that this business can produce for me? And in my circumstance, what I'm using most of the time is 22%, but typically I'm using a range between 15 and 22%, depending on my confidence in the cash flows that I'm projecting. So in other words, if I am very, very confident that my model for cash flows in the future are very, very conservative and are very likely going to happen, then I might be using a discount rate of as low as 15%. That's kind of my minimum. And then depending on how confident I am, if I'm not as super confident in those future cash flows, then maybe I'll be using a 20% discount rate or a 22% discount rate. And the difference between a 15% discount rate and a 22 is my margin of safety. So that is sort of the range I use depending on how much of a margin of safety I think I need to feel confident that I'm going to make a particular return in this investment. Now, the last thing I want to mention before we jump over to my spreadsheet so that you can easily use the discounted cash flow without having to deal with any of the nitty-gritty mathematics is that now that I've changed the terminal value from a exit multiple of 10 to a perpetuity model, you'll notice that the intrinsic value and the buy prices that you get for your businesses will be slightly different from using the previous spreadsheet. And the first thing you'll probably notice is that if you're using a discount rate of 15 to 22% for your target return, then the buy prices are pretty much the same. There's pretty much no change between using a 10 times multiple and using a perpetuity with no growth. However, if you're looking at, and also the other thing is that if you're looking at intrinsic value and you're using a risk-free rate of anything above 3%, then again, you'll notice there's a slight difference. Using a perpetuity is a bit more conservative, but they're pretty much the same. But the difference that you will notice is if you are calculating intrinsic value and you're using a risk-free rate that is less than 3%. If you're using a discount rate, for example, like the current risk-free rate, which is 1%, you will notice that the intrinsic value is substantially higher than it was using a 10 times multiple. And the reason for this is because, remember, the intrinsic value is supposed to compare the future cash flows of the business to the risk-free alternative, which is currently about a 1% return. So the intrinsic value has blown out basically because if you're just trying to make more than 1%, then you're willing to pay a huge amount for those businesses because if it's a great business and it has been growing in particular, then for you to make a 1% return on that business is not a very high bar. You're pretty much willing to pay any price for that business. And that's why the intrinsic value numbers are going to look particularly high if you're using a risk-free rate that's around 1 or 2%. And the problem with this really is that, historically speaking, interest rates have not been able to sustain low levels for very long. So while interest rates are very low right now, and that gives us these huge intrinsic valuations using this method, it's likely that in the future we will see interest rates that are higher, and therefore the intrinsic value for those businesses will come down as those interest rates go up. So in simple terms, looking at intrinsic value in a low interest rate environment is basically useless. And it doesn't really matter anyway, because I don't really use intrinsic value for anything. What I actually use is the buy price calculator. What is coming out as the buy price? Both the intrinsic value and calculating the buy price of a business are using a discounted cash flow. The only difference is the discount rate that I'm using. So I'm never using, I'm not really using intrinsic value and looking at intrinsic value. I'm looking at the buy price of a business which uses my 22% discount rate. What price am I willing to pay for me to be able to make a 15 to 22% return on an investment? So that's just something I wanted to make you aware of when you're using the new spreadsheet. You might notice some discrepancies, but with that said, I know this has been a very long video, so props to you if you've stuck around this long, but the new spreadsheet is available down in the description below. It's completely free, so go check it out if you're interested, and we'll jump over to my computer briefly to go through and walk through how you can use the new spreadsheet so that you can go out and calculate the discounted cash flow and therefore the buy price of a business that you're looking to invest in. All right, so we are now in my spreadsheet, and as you can see, the only major difference that you will notice from the old spreadsheet to the new one is that there is now this terminal growth rate cell here that requires you to put in a percentage, and of course that percentage is the growth rate of cash flows after the 10th year. So what I went ahead and did was I inputted Facebook's numbers from my earlier spreadsheet, and I thought that we would just take a look at how the buy price has changed now that we are using a different terminal value method. So as you can see, previously, if we're using a 22% discount rate, which is our typical target return, the buy price for Facebook using our models was somewhere between $105 and $170 per share. And that has come down slightly to about $86 per share up until $132 per share. So it's come down, I would say, about maybe 20 or 25% using this new model. I mean, we could make the assumption that, okay, Facebook is going to grow at some rate after the 10 years. So if we put in let's say a 2% terminal growth rate, then you can see that it will bump up the buy price slightly, but it won't make it won't make much of a substantial difference. The other thing to notice is the intrinsic value. So if we're using a risk-free rate of about 5%, you can see that, let's have a look at the old intrinsic value. Old intrinsic value ranged from $800 billion up to $1.5 trillion. For the whole company, that is, and that changed to 1.2 trillion to 2.3 trillion. So the intrinsic value has gone up using this method. But as I mentioned, if you're using really low, if we're in a really low interest rate environment like we are now, where interest rates are about 1%, then you're going to notice a substantial difference. And that is basically representative of the fact that if you're just trying to make a 1% return, then the price that you're willing to pay for a stock like Facebook is basically infinite, because to make a 1% return on Facebook, you could probably pay pretty much any price. And there's a good chance that you will make 1% over the very long term. So I would pretty much be disregarding intrinsic value unless you're putting in a risk-free rate that's more sort of in line with the historical average, so something more like a 5 or 6%. But ultimately what we care about is what is the buy price based on our required rate of return, which is what we're using here, which is going to be something between 22% or maybe as low as 15% if you have really high confidence in your models. So focus on the buy price and the buy price per share. And I hope you enjoyed this video, and I hope you sort of learned a little bit more about the different types of terminal values, and you can sort of make up your mind which one you think is the most appropriate. I think that using a perpetuity model with 0% growth or 1% growth at the most makes sense as a long-term value investor. But I hope you guys enjoyed this video. Let me know your thoughts down in the comment section below, and for now, I will see you guys in the next video. See you later, guys.